So crop insurance, how can we use crop insurance for price protection? I am a marketing guy at heart, and so we know that the revenue formula is price times yield. And, I don't know how to guess yield at this time of the year. I usually go into a year thinking we're going to have an average crop, both myself, both my county, but I do know where prices are at right now. And prices are giving me a tremendous opportunity. And we showed that back at the beginning, that the corn price at $5.75 average so far this month, the highest we've had in 11 years. Much higher than we had the previous, 8 or 9 years that we've come off of. Same with soybeans. We're going to be possibly the highest we've ever had for crop insurance. So I'm looking at crop insurance this year, revenue insurance, as a way to be able to protect prices at these very high levels. The two tools that I really like the most, and I realize that our company, as well as many other companies, have private products that you can use to get higher end coverages. But what I like to use are the RMA products because they're subsidized. Supplemental coverage option, SCO, is a band of county level coverage that starts at your level of protection and goes from there up to 86%. ECO was a new product a year ago. It starts at 86%, goes to 86 to 90 or 86 to 95%. Both of these are county-based products. And here's a snapshot of how they would work. Again, these just stack additional levels of protection on top of your individual coverage. So the blue line would be my individual revenue protection, where I could buy up to 85%. The next level of protection would be SCO, which would start at whatever level I've got up to 86. Now, notice it does say SCO or ARC. And this is where the Farm Bill comes into play, because SCO is an insurance program. ARC is an FSA program. Both of these are very similar. They're both county level coverages or protections, and they start at 86%. So the government will not let you do both parts. You can only do SCO or ARC. You cannot do both. And if for some reason you sign up for both, you'll get penalized 20% of the SCO premium, and your coverage will be voided. So you do not want to make that mistake. So you'd have to make a decision between SCO or the ARC program. The next level of the band of coverage is ECO. You can go up to 90 or 95%. So the decision is, how much do I want to shrink my deductible this year? And ultimately, to me, the decision is, what do I want to do with my crop insurance this year? Is my goal to just do what I've done in the past to cover part of my expenses, or maybe as much of my expense as I can with an individual policy? Is it to cover all of my expenses? Is it to lock in a profit? And I think some of this comes down to how aggressive of a forward seller are you going to be? You're going to sell the heck out of this crop, like I mentioned the two guys earlier. Are you going to do what you've done in the past marketing wise? And in that case, maybe you want to consider using these products as a way to be able to protect the high end on prices. So a lot of things to be decided here as we go forward. But going back to the December corn chart that I showed a minute ago, this is where these lines come into play. And let's assume that we start out with a projected price at $5.70. That's the green line up at the top. Actually, we're running a little higher than that right now. But if we were to do that, and you were to buy an 80% RP policy, and let's again assume we have an average crop on the farm this year, then with revenue coverage at 80%, it would take a 20% drop in price to start to trigger a loss with an average yield. So essentially, I'm getting a put option with my revenue policy at $4.56. Again, assuming an average yield. I could bump that price put by adding SCO or bumping my coverage to 85%. Both of those then would give me a price trigger around $4.90 if we have an average yield. It would take a 14% drop in price to trigger a loss. If I bump to ECO at 90%, now I've bumped my price trigger to $5.13 with an average county yield. And at 95% ECO, I would bump my coverage up to $5.42 or my price trigger. Now you start getting up where the market's been trading. So again, what's my goal with crop insurance this year? Is it to buy enough coverage to cover some of my expenses? Is it to cover all of my expenses? Or is it to try to lock in a profit? We know that yields are going to change. We know they're going to up or down one way or the other. But at this time of the year, I don't know what that's going to be. I go in expecting an average crop. So what can I get price protection wise? So I want to look at a couple of examples. Number one is, let's say you're a producer that buys 80% RP coverage. Then I want to look at adding the SCO up to 86 and the ECO up to 90%. So I'm going to add an extra 10% band of county level coverage on top of my individual policy. So we've got this indemnity calculator that we can show how this works. And the yellow boxes are what I have to fill in. The Hamilton County expected county yield is 194.1. I'm going to say that the county yield stays the same this year. For doing the math right now, I'm going to buy a 10% band of coverage from 80 to 90% that stacks on top of my individual revenue protection policy. Then we get to calculate what that value of that band of coverage is. And this is where you get to use your APH. The higher your APH is, the more dollars of coverage you get. So it does benefit producers whose APH is higher than the county average. But we take your APH over here on the left times the higher of the base price or the harvest price. And the example I'm going to use is that we start out with 570 corn and the corn market goes down $1. We have a good crop around the country. Corn goes down $1. 470 historically is still a high price, but this year it would still be down $1. But in this example, I would take the base price times my 200 bushel APH would give me the expected crop value of $1,140 an acre. You know, think about that for a minute, that our expected crop value this year is well over $1,100 an acre. To me, that's pretty fascinating, probably the highest we've ever been able to use. But we take that number times 10%, this band of coverage, it's going to give me my dollars. $114 is what this 10% band of coverage is worth. So if I lose that whole entire 10% band in the county, we're going to get the whole $114. Next, we calculate our loss. We know that we started out with 570 corn. We end up at 470. So we ended up producing 82.5% of the expected county yield or revenue, which was below our trigger of 90%. So it is 7.5% below it. So we had a loss at 7.5%. We divide that by the total 10% band, which means we're going to collect on 75% of that band of coverage. Multiply that by the green box, 114, we're going to get a check for $85 an acre. So in this example where the yield didn't change, but the price just went down $1, you're going to get 85 bucks an acre back. And what's to me kind of interesting, if I buy 80% RP coverage on my farm, and let's say I have an average crop, then we're not low enough yet to trigger. We ended up producing 82.5% of our expected revenue. If I buy 85%, we're just barely starting to trigger. So by bumping my coverage up to 90% here, you can trigger a loss that much quicker. And if I think this year there's pretty good odds that the price could go down, again, if you go back and look historically, and I didn't really do that, but if you go back and look historically at these high price years, we tend to see the markets trend lower. And so if I think that's the case this year, this might be something to consider. What I showed you here was just one example of price and yield. This matrix is going to show you over 200 examples. And so if you kind of work around the matrix, we've got county yields across the top. We got prices, harvest prices on the left-hand side. We could have a 199. Let's say we have a 199 county average. And if you go down here at 499 corn, we're getting money back. So essentially, we got a $5 trigger if the county was 5 bushel higher than expected. So I think that's kind of fascinating to think you could have a policy that would trigger a loss at $5 a bushel, even with a good crop. If we get over here to the left, we start to maximize that amount of coverage, that 114. We've had between yield and price drop, we get the whole band of coverage. And at this point, then your underlying RP policy is starting to kick in. You got the 80% coverage. We've lost that whole band of coverage down to 80. At this point, your RP protection is going to start to cover you. What if we end up in the top left? We have a $2 bump in price because we had a drought across the Corn Belt again. We end up with a 148.5 county yield. You're going to get a payment of 154. So your coverage went up 40 bucks. And the reason is that we get to use the higher of the base and the harvest price. So as long as you have an underlying revenue policy, we're going to get to use 770 here times 200. Your dollars go up, which means your dollars of protection go up, in this case, to $154. So that's where the harvest price option comes into play. If we have another bad crop in the county, maybe a 2012 type situation around the Corn Belt, then you're covered on the higher price as well. A couple of nights ago, I had somebody ask me, what happens if you end up over here in these white boxes? My comment is you probably had one of the best corn revenue years you've ever had, because we've got high prices, you've got good yields, you didn't need the policy. This year, I mean, and in some cases in 2021, that was the case as well. You know, a lot of folks bought ECO last year, may not have needed it. We had a good year. Prices were up, yields were up, and that's what we really want to have happen. You don't want to be down in these situations where we're collecting. But because of how high we're starting with prices this year, you know, not getting a payment really means we've had a really great year. If you're buying only 80% only, then your triggers would start to the left of this yellow line. So everything to the right of the yellow line is by bumping that coverage from 80 to 90 with this ECO and SCO. That's where you've started to move your coverage that much higher. Within our quoting system, we also have this historical tab, NAU Country. We've got the ability to go back and show you what would have happened if we would have had these products available. And so even though SCO has only been out for 5 or 6 years, ECO was new last year, we can go back and see what would have happened. And what's really kind of fascinating, and this is in Hamilton County on corn, is that each of these 4 years where SCO and ECO would have triggered were all the very high price years that we had. 2008, 2012, 13, 14. Now 12 was driven by bushels. The market ended up higher in 12 because of the drought, and we ended up triggering a payment. But 13 and 14 were 2 of the very high price years we had. In addition, so was 2008. So here we are again. We're up at 570 something on corn. Maybe this is a year where you want to consider this. And if we go back to 450 corn next year, I might not want to look at adding on the additional coverages. But because of how high the market is this year, the opportunity is there. We'll look at a second example, and this might be for folks that are buying 85% RP coverage already. You're able to lock in coverage on your farm at the highest level, but this year you want to take a look at protecting that shallow loss revenue. And this is kind of like those guys that I was talking about in Missouri were looking at doing. They were looking at buying their RP coverage up to as high as level as they could, and then adding the ECO to protect that top band that maybe you're not going to go out and forward sell above 80% or 85%, but you can utilize the ECO program to help protect that band of coverage. So if I buy that 9% band of coverage from 86 to 95, here's what the indemnity worksheet would look like. That 9% band, using the same numbers I used before, is worth $102.60. And in this case, our loss ended up being, well, our quote, or this worksheet dropped, it will take it below 86. In other words, we maxed out our loss. And so we get the entire 102.60 because the price went down $1. Now I did the math the other day to look and see where that stopped. Actually at 490 corn, we maxed out that entire 9% band. So if you think there's a good chance corn's going down 80 cents from spring to fall, then you'd get the whole $102 back in that case. And premium, I know we're a lot of you want to know premium cost. I think it's been running roughly a third, maybe a little less than a third of your dollars of protection. So, but if you're looking at a way to protect that price on these high end bushels, to me, this is one great way to do it. The government's picking up 45% of the cost of the ECO program. By the way, the SCO is subsidized at 65%. So these are good programs to be able to protect on these high prices. If I look at the matrix, by going to 95%, I've bumped to the right a little bit more, as well as raise these bottom numbers. So you can see where, you know, a lot of places on here, we max out that 102. If I'm in these white boxes, again, I've had one of the best revenue years, maybe the best revenue year on corn that I've ever had. And if I just look at the history of what ECO would have looked like, you can see we've got a few more years because I bumped this to 95%. So 2020, ECO would have triggered some losses that year. 12, 13, 14, 09, 08 would have all been years where ECO would have paid at the 95% level. So we can show you this for any county, for any crops, if you're interested in looking at it. Same with soybeans. I'm not going to go through examples with soybeans, but from a price perspective, the higher this base price gets, the higher these triggers get in place as well. If we have an average crop with SCO at 86% or RP at 85, I've got price protection roughly at 1175 to 1180. Bumping that to 90% gets me well up over 12 bucks. 95 gets me up over $13. So again, it comes down to what's my goal with insurance this year? Is it to just cover some of my expenses? Is it to cover all of them? Or is it to possibly lock in a profit using some of these higher numbers?